Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome. Today, we're diving into a really fascinating and, frankly, pretty controversial part of Canadian tax law, the SIFT trust. What happens when an investment vehicle that's supposed to be a trust starts to look and act a whole lot like a corporation? Well, that's the multi-billion-dollar question that led the government to completely rewrite the rulebook. So let's unpack what these things are, why they were created, and why they matter so much. Here's how we're going to break it all down. First, we'll get a handle on what a SIFT trust is from a high level. Then, we're going to get into the weeds with the 3 specific conditions that make a trust a SIFT trust. After that, we'll see the real punchline, how they're taxed. We'll have to decode some key legal jargon, which is crucial. We'll also look at who gets a pass, the exceptions to the rule, and finally, we'll zoom out to see the big picture of tax policy and fairness that really started this whole thing. Okay, let's start at the very beginning. Before we jump into all the complex rules and the math, we really need to build a solid foundation. So the first and most obvious question is, what exactly is a SIFT trust? Think of a SIFT trust like a recipe with 3 essential ingredients. First, it has to be a Canadian resident trust. Simple enough. Second, its units, which are kind of like shares in a company, have to be traded on a stock exchange. And third, and this is the absolute key, it holds what the law calls non-portfolio properties. Now, for now, just think of these as assets that basically signal the trust is acting more like an active business, not just a passive, hands-off investor. So why all the fuss? I mean, if it's just a trust, why create this whole complicated set of rules? Well, the answer gets right to the very heart of tax policy, and it really comes down to one word: fairness. The government saw these publicly traded trusts getting all the benefits of being a corporation, like access to public capital markets, but without paying corporate-level taxes. And that tension, that perceived unfairness, is the entire reason the SIFT rules exist today.
So, how does the government officially decide if a trust has crossed that line? Well, it's not a subjective judgment call. It's a very strict 3-part test right in the Income Tax Act. A trust has to check all 3 of these boxes to get tagged as a SIFT. Let's walk through each one.
So here they are, the big 3. Number 1, it's got to be resident in Canada. That's straightforward. Number 2, it has to be publicly traded. This is what separates it from, say, a private family trust. And then number 3, it must hold that non-portfolio property we mentioned. This last one is the most complex, and honestly, it's the real engine of the entire SIFT regime. It's the one we really need to understand. Okay, so let's say a trust meets all 3 conditions. It's a SIFT. Now what? Well, this is where the rubber hits the road. Failing this test, or I guess passing it, triggers a totally different tax reality. It fundamentally changes the game for how that trust's income is treated. This slide shows the difference in black and white, and it's a stark contrast. A regular trust is basically a conduit, a pipeline. It earns income, and then it can deduct the amounts it pays out to its beneficiaries. That income just flows right through, and the beneficiary is the one who pays the tax. But a SIFT trust, that pipeline gets blocked. It is specifically denied a deduction for its non-portfolio earnings when it pays them out. That income gets trapped inside the trust and is taxed right there at the trust level, almost exactly like how a corporation pays tax on its profits. And to make sure this is airtight, the Income Tax Act gives us a very specific formula to calculate the exact amount of income that gets trapped. Now, I know formulas can look a little intimidating, but the purpose here is actually pretty simple. All it's doing is surgically isolating those non-portfolio earnings from any other kind of income the trust might have. This ensures that only the income from those business-like activities gets hit with the special tax. Okay, so if the trust is paying tax, what about the investor who receives the cash? Are they getting taxed twice on the same dollar? Thankfully, no. The system has a pretty elegant solution for this. That amount the trust couldn't deduct is treated as an eligible dividend when the beneficiary receives it. And this is a huge deal for the investor because it means they get to claim the enhanced dividend tax credit, which can significantly lower their personal tax bill. It's the system's way of balancing the scales. We've been throwing around some pretty specific legal terms, especially non-portfolio property. The entire definition of a SIFT really hinges on what that term actually means. So to really get this, we have to do what all tax professionals do. We have to decode the jargon right from the source, the Income Tax Act. All right, let's tackle the big one, non-portfolio property. This, right here, is the heart of the SIFT's definition.
Conceptually, it's any property that suggests the trust has gone beyond being a simple, passive, hands-off investor. It signals a much deeper, more active involvement. The Act basically says it can be one of three things: a major investment in another company, a heavy concentration in Canadian properties, or assets you're using to run a business in Canada. So these are the three main buckets. First, you could be holding a significant stake in another entity, which the law calls a subject entity. Second, you could own a lot of Canadian real estate or resource properties. And third, you could just be using property to run a business here in Canada. If a trust's assets fall into any of these categories, it's a pretty good bet it's holding non-portfolio property. Let's focus on that first category for a second: securities of a subject entity. This isn't about owning a few shares of Bell or RBC in a portfolio. These rules are designed to catch situations where a trust holds a significant, maybe even a controlling, stake in another business. And this significance is measured by two very specific ownership tests. So here are the two tripwires. First, does the trust own more than 10% of the other company's equity value? You can think of that as a test of influence. The second tripwire is a test of concentration. Is the value of those securities more than 50% of the trust's own equity value? If you cross either of those lines, boom, those securities are classified as non-portfolio property. Now, for that second category we talked about, a trust can also get caught if its investments in Canadian real estate or things like resource properties become too concentrated. And the magic number here is 50%. If the total value of these specific Canadian properties is more than half of the trust's own total equity value, it crosses the threshold. This rule is really designed to separate trusts that are essentially operating as real estate businesses from those with more diversified investments. And what about that term subject entity? What does that mean? Well, it's just the fancy legal term for the thing the trust is investing in. The definition is really broad. It covers Canadian corporations, other trusts, and partnerships. It even catches non-resident entities if most of their income is coming from Canada. This wide net ensures that you can't just use a different legal structure to get around the rules. Okay, now that we've seen just how broad these rules can be, it's just as important to understand what they don't cover. The government was very deliberate in creating specific and very important exceptions for certain kinds of entities. The most significant exception, the one everyone knows, is for real estate investment trusts, or REITs. As long as a trust meets all the specific conditions to qualify as a REIT for the year, it gets a pass. It is explicitly carved out of the SIFT definition. There's also another key exception for what are called excluded subsidiary entities, which are basically private companies owned by a REIT or a SIFT, allowing for more complex but still compliant group structures. We've been deep in the technical weeds of the what and how. Now, let's pull back up to 30,000 feet and address the most important question of all. Why? Why did the government go to all the trouble of creating this complex regime in the first place? Understanding the policy goal is absolutely key to making sense of the rules themselves. You know, these rules didn't just appear overnight. There was a clear, deliberate transition. The government basically drew a line in the sand back in 2006, identified the existing players, and gave them a 4-year window to adapt. During that time, they could operate under the old rules as long as they didn't grow too aggressively. Then, come 2011, the new regime became the law of the land for everyone. This phased approach was really designed to give the market time to adjust without causing a massive shock. And that brings us to the ultimate goal. You could really boil it all down to 2 words: tax fairness. Or maybe 3, leveling the playing field. Before these rules, you could structure a business as a publicly traded trust, get access to all that public capital, but avoid paying corporate tax. The SIFT rules were created to close that loophole and ensure that if an entity is going to earn income using a publicly traded vehicle, it faces a tax burden that's comparable to a publicly traded corporation. It's all about protecting the corporate tax base. And this brings us to our final thought for today. The SIFT regime is a fundamental change, imposing a corporate-like tax on what is legally a trust. The policy question that remains, and is still debated, is whether this solution strikes the right balance. Does it successfully achieve tax fairness without choking off the investment flexibility that trusts can offer to the market? It's the central tension at the very heart of this entire piece of legislation. Thank you for joining me.